Well, joining us now on the phone with to really talk about the outlook, the economic outlook for 2011, because all of these factors do play a role here. We do have Professor Robert Mundell from Columbia University. Professor Mundell is a Nobel Prize-winning economist. Also with us on the phone, Businessweek economics editor Peter Coy. Thank you both for joining us. Dr. Mundell, let me kick it off with you. Where do you see the economy headed? Because we know forecasters have been ratcheting up their numbers, becoming more upbeat. Are you more upbeat about the outlook for 2011?
Yeah, well, we had quantitative easing 1 in March 09 and last year, and that led to an expansion, and it led to a lower dollar, and you got a recovery in the fall, and that recovery was going pretty good last fall until the dollar soared again at the time of the European debt crisis, and the euro went way down to about $1.15, and that appreciation of the dollar really killed off that recovery and really made it necessary to get into this quantitative easing 2, which should have happened before. So, Professor Mundell,
I mean, let me ask you then, so what do you see happening in 2011? Because as I said, people seem to be getting more upbeat. Give me a number, give me a figure of what you expect in terms of economic growth.
Well, I don't see economic growth being any better than 2%. Which is very low because we're at a stage of the cycle with unemployment that's 3 or 4 percentage points above what it should be.
Right. Peter, that is low. I mean, you track this stuff. You know everybody's been kind of ratcheting up their numbers. Does that surprise you?
It surprises me that Dr. Mundell is coming in with such a low number. Ordinarily, when the economy is as depressed as it is, it rebounds like a spring that's been pushed downward. Now, we haven't had that happening this time. The economy technically came out of recession more than a year ago. We still have unemployment at 9.8%. But you would think that eventually the engine would start to kick in and we get that stronger growth and catch up to our potential output.
Yeah, I agree with that, but the situation here is really completely different because you've had this financial shock to the economy that has devastated confidence, and there's nothing around the corner that looks as if there's going to be a strong push for the recovery. For example, housing. It doesn't look as if housing is going to be spearhead any kind of recovery, and you can get something in automobiles, but you're not going to get it in defense, and because of this, there's no basis for that expansion.
You know, Dr. Mundell, we talked with Jeremy Siegel of Wharton, I think it was about a week or 2 weeks ago. He's had some great calls, certainly on the market in the last couple of years. He's a lot more upbeat about the outlook, and he says, you know, in terms of what he's seeing, the higher rate environment out there, he says that's not something to be worried about. That's a good thing. That's a sign that things are getting better. The economy is getting stronger, and that really Fed policy is working. Do you not buy into that argument? Do you not agree?
Well, the problem is that the Fed policy was working 3 or 4 times before, but then it was cut off because the dollar soared. The dollar soared by 30% in the third quarter of 2008, and that's what really broke the back of the economy and created the financial disaster. And then the dollar soared again in the spring of 2010, and that cut off the recovery again. And each time quantitative easing comes along to correct for the mistake that they made by allowing the dollar to soar. The fact is that the Fed has, I think, been negligent in really neglecting, not taking into account the impact of a strong soaring dollar each time.
Peter, I know you track this stuff, and I'm guessing you've got a million questions for Dr. Mundell. I want you to jump in here.
Yeah, well, what I would like to do is talk to him about the euro, because that's his expertise, world famous for his a theory of the optimal currency areas, which helped to lay the groundwork for the creation of the single currency in Europe. And the big question people have now is whether the euro can survive, and then the second question is, was it ever a good idea in the first place? The theory of an optimal currency area is brilliant, and the question is whether the Eurozone ever actually complied with the criteria that Dr. Mundell himself set out.
Well, one of the sine qua non of any kind of monetary union or fixed exchange rate system is a fiscal balance. because if you don't have fiscal balance, then you're going to have speculation against the currency and depreciation. When you got the euro, countries started to, they had the fiscal imbalance, but they didn't get the penalty of depreciation.
Right.
And so that really muddied the water for the rest of Europe, and it created almost a euro problem from what would ordinarily be a national fiscal problem.
What's the chance of the EU cracking in 2011, falling apart?
Yeah, well, I'd say that the chances are zero. But the chances that there's going to be a need for debt restructuring of one or two or more of the countries in the next year is definitely very substantial. So I believe that we will see a debt restructuring. But there's no reason for a collapse of the euro, because it wouldn't help any of those countries to shift to away from the euro to another currency. As soon as they shifted away to another currency, people would know that their intention is to devalue it, and nobody would take it, nobody would hold it, nobody would use it. So it wouldn't get off the ground.
All right, interesting. And Europe obviously is going to continue to be a big issue next year. So too is China. We got some news on Christmas Day, raising rates again. They've been pretty aggressive, proactive, expected to be that way also next year. How do you see China playing out and the impact on the global economy, the U.S. economy?
Well, the raising interest rates in China doesn't do much good because its exchange rate is essentially fixed. And the increase in the interest rate is going to, if anything, attract more hot capital to Canada, to China, and to bring more money into. And you're not even going to get a lack of liquidity, because money comes in and the central bank has to buy up foreign exchange, and it's very hard to sterilize that.
So the point is that you can't have an independent monetary policy if you're going to have a fixed exchange rate and open capital flow.
That's right. They really should, if they're having the fixed exchange rate, they should let the monetary system work itself out to a new equilibrium.
Dr. Mundell, 20 seconds here. So it sounds like, in your view, it's going to be another tough year when it comes to the U.S. economy. Just quickly.
Yes, it's going to be a tough year. I hope the biggest risk is that the Fed will, if the economy gets going, the Fed will let the dollar soar again. I think they should put a floor to the euro at about $1.30. And I think it is also necessary to add tax cuts, and the tax cut I would propose would be a 20% corporate tax.
All right, we're going to leave it on that note. Great discussion. Dr. Mundell, professor at Columbia University, thank you, and our own Peter Coy over at Bloomberg Businessweek. Our thanks to you as well.